Good morning, ladies and gentlemen. I'm delighted to be here to share with you the perspective of a regulated global market infrastructure provider and what we can do to support the Capital Markets Union. We have been a supporter of the Capital Markets Union since it was initiated in 2014, and our clear goal is to promote the increased use of efficient, stable markets, capital markets in that sense. What we have to keep in mind, and you have referred to that, is what we need is a strong connection between capital markets and the economy, and that we need to further build on that relationship in terms of a serving relationship that we're looking at. First of all, I'd like to compliment Mr. Wilhelm and his team on the Capital Market Union approach that they have chosen. To be honest here, I was rather surprised to see such a comprehensive and ambitious package, and I think it's realistic though. So what you've said initially, that it is a pragmatic way to look at the different bits and pieces that we can handle, is a quite good start there. I think we're all aware it will be only the first step, and while legislation is a key in delivering an appropriate framework, we have been very appreciative of the fact what you, I think, called a toolbox, which is basically encouraging the private sector to deliver suitable market-driven solutions on the basis thereof. And referring to the ecosystem that we need, we have, for example, followed this call and have launched a market-driven initiative which is called the Deutsche Börse Venture Network. It basically closes the gap that we identified in the pre-IPO ecosystem and should help growth companies to find the additional funding that they need before they even can think about entering the capital markets directly. Nevertheless, it is quite critical that the framework conditions are set in the right way. Therefore, we very much welcome the call for evidence that was published at the same time, which will help reflecting on the cumulative impact of evidence that we have seen from financial regulation. And we think it is really important to keep European competitiveness at a global level in mind. So, for the call of evidence, I think it is true that for the last 6 years, has been a period of intensive rulemaking for the financial sector. In our view, the EU has taken essential and necessary steps to implement the G20 goals and has restored financial stability and public confidence in the financial sector. However, there's more to come, I would say. So what we see now is a financial system that is much stronger than it was before. We see risk management and a stabilizing effect that supports safe and efficient environments, either through CCPs or central counterparties or central securities depositories. It is crucial that economic growth can only take place on the basis of this financial stability and integrity that was built during the last years. However, by my own experience, we are also aware that such a huge reform package that we have seen with all the different names will never be perfect. Consequently, we consider the call for evidence a starting point for regulatory reconciliation and general streamlining before we look into new regulation to come. It is indispensable to check whether an unintended consequences that we find resulting from the large amount of legislative measures and look at the combined interactions of the different regulations that we have seen and also on their combined impact on markets. To be clear, I don't think it is about changing the core of the reforms. It's really about looking what went good and what didn't, and checking and having the checks and balances there. So consequently, what we need is growth, innovation, and competitiveness, and these should be built on the basis of stability, fairness, and transparency, which I think are guiding principles that have experienced a much-needed renaissance ever since the financial crisis. And financial markets could facilitate this process. Talking about harmonization. Facilitating the harmonization of rules and standards is essential to eliminate costly barriers. I think we have discussed over the past 10 years quite a few times the Giovannini barriers here in this context. It is ultimately about reducing complexity for investors and companies. Significant fragmentation still exists in the public domain, and I think we have heard a few named here already, which is securities law, it's insolvency law, it's accounting standards for SMEs, so it's a rather long list that we're looking at. But when we're talking harmonization, we're also talking taxation. And what we need is to create a favorable tax environment in Europe. And in addition to the, I think, work program that we have seen already, there is a new consultation out there on the common consolidated corporate tax base across all 28 member states, which I think will be an additional measure that will support the process. What I want to highlight here is the fact that at the moment, equity is more heavily taxed than debt in most EU countries, which is, of course, disincentive to equity investments. So what we need is basically rebalancing the current bias towards debt financing. It is clear that from an investor perspective, paying lower taxes on equity investments would incentivize the provision of equity capital which is needed. And I suppose I'm rather here in preaching to the converted and saying that the persistent call of some European countries for a financial transaction tax is exactly the wrong step that we're seeing here. We don't expect that the intended regulatory objective or the financial goals will be met, and unfortunately, additional negative effects should be expected, especially on the savers and the company side from such a tax. What we believe is that actually the opposite is necessary. One of the most pressing bases is to revive investor trust and to support a healthy equity culture. And I just brought you one number from my home country, Germany, which is, I think, really devastating, actually. What we have seen is that over the last 30 years, equity value has risen 30 times. However, only 13% of the German population is actively engaged in the stock market. And that in such a low interest environment. And I think that tells the story there. So the last point I want to mention is liquidity. I think what we see is that market-based and regulatory drivers are reducing market liquidity. Dealer risk tolerance has notably declined, and bank balance sheets are strained given stricter capital requirements. We see this on our markets in diminishing proprietary trading and reduced market-making activity. As a trading venue, we organize price formation and encourage liquidity. And we also encourage measures that are geared towards risk takers' ability to take on risk, trade, and effectively provide liquidity and making markets. The ability of market participants increasingly depends on the most effective use of risk capital. And this is basically done through cross-margining capabilities, collateral services. So the market has reacted to that. So concluding, I think the first thing that we need to keep in mind is there needs to be a strong link between the economy and financial markets. We're optimistic that this can be achieved by a thoughtful calibration of regulation, and if we have the right incentives set to increase investor trust and at the same time remove barriers to cross-border investments through harmonization, we will gain ultimately the liquidity that we need for a CMU to work. Initiatives already implemented, and I referred to the venture network earlier, I think are only the starting point. There's a lot of effort needed from the industry, from regulators to get this thing going. Thank you.